Hi, you're watching Business Plus. First up, we have the key domestic macro data numbers for you released just a few minutes earlier, with retail inflation rate based on CPI moderating to 5.66% in March. This is against 6.44% earlier. The numbers will come as a relief for the Reserve Bank of India, as it'll be below the central bank's upper tolerance band for the first time this calendar year. Coming to the numbers part specifically, March food inflation has come in at 4.79% compared to 5.95% in February. Housing inflation has come in at 4.96% compared to 4.83% last month. Fuel and light inflation has come in at 5.11% compared to a mammoth 9.90% in February. Inflation has been a bogey area for the government, and the central bank has been forced to repeatedly hike interest rates to rein in inflation. The RBI Governor Shaktikanta Das last week explained that the reasons behind the unexpected pause in rate hikes, all through the jury was out on that. We have with us Srinath, Sridharan and Karan Mehrishi to help us sort of read the latest macro data. Let me start with you, Sridhar. The numbers have come in, and finally there is some relief, and it seems that the rate hikes that the RBI had been doing are now coming into effect, and the pause seems to have been worth it. What are your initial thoughts?
The rate hikes definitely seem to work, at least for this month. Let's hang in there with the summer sweltering heat hitting there. The oil prices globally is still a challenge, right? We are okay as long as the crude prices are below $85 to a barrel. If it starts inching upwards, then all these inflation numbers could go for a hike. Food inflation still is a kind of a worry for me, because if you notice, there's another macro view that the IMD, the weather department, gave out saying monsoon will be normal, whereas SkyMet, which is the private forecaster, said the monsoons would be 2/3 of the usual. That's a concern, because going forward the next couple of months, they will have a bearing on inflation. Today, I think RBI's governor must be feeling very vindicated with his decision for the rate decision last week. But I wouldn't write it off saying I wouldn't start cheering yet.
Okay. Karan, let me bounce it off you and take it from where Srinath had left it. 4.79% compared to 5.95% specifically on food inflation. And of course, the forecast that came, contradictory forecast between IMD and SkyMet. So, with monsoon coming and perhaps a likelihood of El Nino, are you bullish on this number to stay within the band, or likely to go higher as the months progress?
Well, to start with the food inflation, it's very important to understand that the food category has a weight of around 46% in the overall CPI basket.
Yeah.
And any elevations here have a significant impact on the overall inflation number. Consequently, I think despite a glut in the vegetable supply, which is around 9.6% weight in the overall basket, food inflation recording an over 6% inflation for much of FY23 and has been a cause of concern, especially given the fact that staples such as wheat and rice, which come under the cereals category, are recording inflation of upwards of 15%.
Right.
The milk and dairy categories, on the other hand, is also a category of worry in the food basket, which has remained elevated. My sense is that rising discretionary income of Indian households will allow them access to protein items, and supply must be augmented to meet rising demand. A similar story is emanating from the personal care items, showcasing very healthy demand for discretionary goods. This is pretty much in line with the healthy growth that has been recorded by the non-durable category in the IIP. Fuel basket, on the other hand, remains elevated despite rising Russian imports. This is happening because of, again, excise on retail fuel, which is not allowing benefits to reach households. Overall, I think from the inflation numbers, we can decipher that India's consumption story is intact. And rising disposable incomes is putting pressure on prices of consumables. So I see this as a simple demand-supply mismatch. I do not see any structural problems here. Coming to the El Nino, I think it's a significant risk for the economy. As the other panelists were suggesting, SkyMet has predicted the LPA at 10% efficiency. What this means is that central and western India may receive less than optimal rainfall, impacting the Kharif season significantly for FY24. So it is possible that food inflation may be stoked further in FY24 as well. And given the weight of the food category, as I was mentioning, this may put upward pressure on the headline number as well.
Okay, so Karan, this sort of weightage that is allocated to the food basket, is this inclusive of dairy, inclusive of milk, or exclusive of milk?
Absolutely. Yes, Kartik.
Okay, so milk inflation doesn't seem to be ebbing at all. In fact, even if food inflation has come down, the real challenge in pricing, in rising prices of milk and milk products still continues to be a concern. So, how does the central bank or any other fiscal measure contain milk inflation?
This is a simple supply-demand mismatch, Kartik. So I don't think a central bank can do anything about it. So it's all about augmenting capacities to meet the demand and the fact that Indian households now have discretionary consumption power. I think this is pretty much in line with how a country evolves economically, and households become they sort of demand more protein-based items, including dairy,
Right.
and it's a normal course of evolution of an economy.
Okay. Srinath, let me come to you. Now, let's talk specifically about fuel and light inflation. And fuel inflation, of course, we are yet to see the real impact of OPEC Plus sort of, cutting down its oil production and the kind of price stabilization, as they call it, but price rise, as we understand. That's yet to sort of hit us and hit the global market as well. So right now, we are seeing that fuel inflation has come down to 5.11% compared to 9.9% in February. But once this price stabilization in the fuel market happens, what should we look at, especially with the summer months approaching, where consumption of power is going to be much higher?
See, that concerns will continue because the pricing, the actual bill we will end up with a new revised bill probably 2 months from now as we do more offtake of crude oil. Two, also our summer months going forward, if the monsoons are delayed, we are going to see a surge in power consumption to the pricing mix for power. I mean, end of the day, we still are dependent largely on fossil fuels. That is going to increase. And I want to link this to also the dairy category that we spoke about, right? I mean, it's interesting to see the last 3-4 years of data on ice creams, chocolates, the dairy products. Despite glutton dairy production, a lot of these get diverted into high value goods in the form of ice creams and other products. Will that continue? Looks like it will continue, which is why we are also seeing out in a kind of a sense the Amul's entry into Karnataka, forgetting the political optics around it. It's also a great market opportunity for somebody who's saying, I have excess supply across my supply chain. I would rather turn it into a high value product in Karnataka. So I think some of those are going to be challenging. Coming back to your OPEC question, we wouldn't see the increased bill until May end or June. So in that way, we are still fine. But our consumption, if you look at the patterns or conversations with travel industry and airline industry, the summer months seem to be going extremely full for them, which is good for them from revenue point of view. But they're all going to burn fuel. All hotels are going to be sold out across the country, which is great for the economy. But at some point, it's going to mean a lot of fuel consumption.
Okay, and data just coming in from the US as well, and CPI in US for the month of March rose by 5% year on year, and this is compared to 6% the month of February. So there is better news even in the US, and CPI in the US has also dropped by a good 1 percentage point. So how does one read into that? Do we expect that even the US Fed is now finally going to get rid of its hawkish stance and pause rate hikes in the next FOMC?
So I think US has a far more structural difficulty than us. The last 10, 15 years of cheap money, ever since the global financial crisis, they've been having the cheap money concept. And in the last 12 months, they've increased the rate so drastically that they just can't overnight turn the wheel. We have had one huge bank get followed by another bank. So US, I wouldn't worry. Structurally, they have long way to go, and they have deeper pockets as well. The bigger concern the US will have is they just keep printing currency. I'm so glad that we don't retort to such quick short-term measures. RBI is far more conservative and prudent, and which is what has kept us safe so far.
Okay. Karan, let me come to you with the same question. What do you expect in the next FOMC with inflation easing a little in the US as well? Though, 5% is still a high number given the growth rate that US sees as compared to a 5.66% versus, let's say, a 6.5% GDP growth. So, what do you make of FOMC's decision on pausing rate hikes? Perhaps for the first time, they will take that action after the Central Bank of India, RBI, has taken the pause.
Well, it's too, Kartik, it's too early, I think, to celebrate right now. And that goes both for the US and the India economies. So Governor Powell reiterated the importance of managing price levels for the overall stability of the macroeconomy. And high inflation means that purchasing power of households is impacted significantly. And that's, I think, the primary concern for the FOMC as well. Now, in order to understand the dilemma the US Fed faces at this time, we have to look at the Fed's Philip curve, which is basically targets inflation rate of 2% with an unemployment level of around 4%. Now, given the fact that unemployment level is hovering at around 3.5, 3.7%, there is no way inflation of 2% target can be achieved anytime soon. And now that the IMF is suggesting that the US economy, which is worth $25 trillion, would be growing in real terms by 1.4, 1.5%, I think the unemployment rate would come down even further. So I think there's definitely prolonged or tighter monetary stance by the Fed, and I think they're just waiting and watching right now, just as the RBI.
Okay. Karan, stay with me and help me make sense of the numbers which are coming on the industrial output as well. So industrial output has risen 5.6% in February, and this is a good growth of about 1.2%. So what is driving industrial output in India? What drove it for the month of March?
Well, I think, for the month of February, we have to look at the overall picture here. I think the IIP print is closely associated and is following the capex cycle, and you see growth in electricity and mining from a sectoral perspective. Also, from the use-based perspective, you see capital goods and infrastructure goods recording a very healthy number. So I think the IIP story will be driven largely by the infrastructure push of India and the persistent public capex. I also think that an overall 5 to 6% IIP growth rate can be considered a very healthy number under the current circumstances. So I think I have no concerns regarding the IIP number as it is being recorded.
Okay. Srinath, what could hit industrial output? Right now, the numbers are looking good and we are seeing a growth trajectory on industrial output. Any risks that you foresee which could hamper this growth curve that we have started climbing?
Domestic consumption monsoon is definitely a worry to watch out for, and globally in terms of pricing margins and some of the key markets like US, UK, which are large importers, if they slow down, then we have a great challenge.
Okay. And any risks that you foresee, let's say with the situation, the posturing that China is doing in Taiwan Strait right now, if things were to go south between China and Taiwan, what kind of an impact do you foresee on India's manufacturing output?
See, I don't think it could go any southern than already the south it is. For years, I mean, China has been flexing its muscle, and I also anticipate it will continue. Will they go into a actual war-like zone like what, let's say, Russia-Ukraine has seen? Doubtful. But otherwise, China has been needling almost every neighbor, including us. So I wouldn't play much heed to it.
Okay. And the fuel prices, as they stabilize or rise, especially in the OPEC plus region, the production from there is going to hit US much sooner than it hits India, because India is still sort of cushioned with the Russian oil that we are importing right now at a cheaper price. So so how is that going to play out for US inflation and thereby the rate hikes that may continue in the US, and eventually how does that trickle down to India?
See, I think on the jocular side, we all expected a late Christmas for the US, saying that at least the first quarter end they will have a better Christmas in terms of consumption jumping back. Doesn't seem to have happened, and which is also reflected in, if you look at the stories, today's TCS story on their US business, and tomorrow Wipro is also coming up. some of those concerns will continue. US will bounce back because end of the day, I think they're very clear that they need a lot of countries, including OPEC oil, to keep them running. And I think that is where a lot of their foreign policies today tilted towards. So I don't see a change in US. They may not go through any short-term difficulty due to OPEC oil.
Right. Srinath, thank you so much for joining us. Karan, Mehrishi, always a pleasure having you with us. And let's move on to another story. And of course, the international flavor continues to rise. And the IMF has revised global growth projections downwards to 2.8%. While India's GDP projection has also been revised to 5.9% versus China's at 5.2%. What are the risks that could derail India's growth? That's something that I want to ask my next guest on the show. Of course, this is Sanjeev Sanyal, who's joining us live right now. Thank you, Sanjeev. Thank you so much for taking out time and being with us. Help us understand this new IMF projection. How is it that there's a downward sort of reduction in growth to 2.8%, while of course India is going to in all likelihood outshine China? How do you see this?
So it's not surprising that there are lots of global economic headwinds right now. Some of them come from the war in Ukraine, tensions in East Asia, and of course there is the lagged impact of various measures taken during the COVID pandemic, which of course, as you will remember, we here in India had warned the West about. So the net result of this is that expectations are now that growth will slow down, and that's what various multilateral agencies are also now forecasting, that global growth is now going to significantly slow down. Of course, it also means that it constrains India's growth as well. My own sense is that India's economy will grow, as the economic survey pointed out, at somewhere in the range of 6.5%. That's slightly higher than what the IMF projects, but in the range of what most of the others project. My argument would be that, look, under these circumstances, this is a decent rate of growth. We can grow faster than this in the sense that unlike in the past, our infrastructure, our banking system and our financial capabilities and so on would be able to sustain growth much higher, maybe even at 8%. But in an environment where our export markets are going to be actually slowing down. In fact, as you may know, that the expectation is that the UK and Germany are actually going to see 0 to negative growth, and growth in the US and other places also going to come down quite substantially. In that situation, when your export markets are slowing down, it is not a good idea to try and force growth ever faster, because what will happen is that when you grow faster, your imports will grow, but your ability to export to other countries will be constrained. So what will happen is that your current account will suddenly blow up. So given that context, I would argue that we should not try to force growth beyond this 6.5% type range, simply because it would unnecessarily jeopardize our macroeconomic stability.
Okay.
For the time being, 6.5 is a good rate of growth, and there will be a time when global conditions will stabilize and we will be able to push it up to the 8-9% range, but never jeopardize macroeconomic stability to force growth for any short period. That is one of the lessons of economic history, and maintaining stability is absolutely critical. And I think the Reserve Bank has been correctly, responding to this situation as it has evolved.
Right. So, of course, the Reserve Bank stance has been vindicated, as you would have just seen the numbers, Sanjeev. But we are sort of talking to you now in the context of Finance Minister Nirmala Sitharaman in Washington in the US. And I want to understand from you, she's, of course, like in India, even internationally, India's G20 presidency is really being talked about at multiple forums. So specifically on the economic front, how relevant do you think is India's G20 presidency to tide over issues such as, oil prices that we were talking about earlier, the banking crisis, free trade agreements, FDI, etc.? Because all these, of course, will have a very direct impact on India's economy.
The G20 looks at various long-term broader issues, and of course maintaining financial stability on the world is an issue that the G20 and specifically the Framework Working Group looks at. There are also groups on international financial architecture and so on. But the key here is that as the presidency of the G20, of course, we will bring many of these topics for debate. I personally think that an important issue that needs to be brought to debate is relates to financial stability and
yeah, we'll come to that.
The stop-go impact of global, particularly Fed monetary policy on the impact on emerging markets. I think this is an issue that India should bring up. Also, I think we should bring up the issue of OPEC intervening, in my view at least, prematurely in the oil market. Because when the world is slowing down, you do need commodity prices to come off in order to ease the pressure. And I think oil prices should be allowed to adjust downwards when the world economy is slowing down, because that would be part of the market process. Therefore, interfering with it, in my view, is wrong. Now, whether or not that should be a G20 issue is something for the India's political leadership to decide.
Of course. So, Finance Minister earlier today, India time, maybe last night, US time, had also spent some time with the IMF's first Deputy MD, Geeta Gopinath. And the two of them really talked about how India should be insulated in the global debt crisis. So talk to us a little more. You also touched upon it, when you spoke about financial stability. So talk to us a little more about the global debt crisis and how insulated is India really, in your opinion?
So what is the main problem globally is the following, is that during the COVID period, many countries around the world, specifically the US, UK, European countries, went out there and splurged both on the monetary side and on the fiscal side. And this caused both larger indebtedness, as well as it meant that all kinds of bubbles and dislocations turned up in the financial system. Now, not surprisingly, and we had warned repeatedly this is what happened, inflation got stoked. So global inflation went spiking up. It is now at the highest level seen in a couple of generations in most of these countries. And so something had to be done. So you now have the monetary authorities in all these countries tightening in order to try and squeeze inflation out. Now the problem is that when you do this, there is a limit to how far you can take this if you are also not doing a fiscal correction at the same time. Because you opened both the fiscal and monetary gates out, but then when you tightened, you more or less only relied on the monetary side, whereas the fiscal side has only allowed for some natural correction to happen. You haven't actually tightened on the fiscal side. There are many reasons for this, political or otherwise. That is not what I want to get into. But the point is, if you rely too much on just one of those and not on the other, the financial system is telling you that you have reached the limit of it.
Right.
And so therefore you now have a situation where either these countries have to accept inflation, or they have to be willing to cause further damage to their financial systems by keep tightening, or at some point what I think is the most reasonable thing to do is to go back and revisit some of their fiscal policies, which may be painful to do when you're having to actually doing fiscal correction in the middle of an inflationary spiral. Obviously it's a difficult thing to do, but that's precisely why macroeconomics is difficult. That's why you don't go out there and splurge irresponsibly when you have an economic shock.
Of course. So, of course, Sanjeev, the data has just come in. You spoke about inflation in the US. The data has just come in. It's grown 5% in the month of March as opposed to 6% in the month of February. So obviously, the monetary tightening in the US has also, it seems to have at least worked, but we let that be sort of, the problem of the US, even if it has an indirect impact with us. I want to stay with you a little longer on the finance minister and her visits, on the business side in the US as of course, yesterday you must have seen last night, the finance minister has said that India's economy is transparent, open and watchable. Of course, she said this in a bid to invite bilateral and multilateral trade with India. And at the same time, Indian business leaders in Washington are also talking to their Western counterparts, saying that any growth plan minus India is practically a non-starter. So, is this an optimistic point of view, or do you see this as core reality today?
I think it's widely accepted that India will be an important, if not already is an important part of the global trading system, and that role is growing. Our role certainly in the services trade world is already well established. It is in goods trade that we have not, I think, pulled our weight, and I think that is something we are trying to correct by inserting ourselves in multiple ways into the global supply chain. There's an area where we are succeeding, for example, in electronics and smartphones and so on, where you've seen Apple, for example, move a lot of its production to India.
Right.
But there are other areas as well that we need to insert ourselves. We have a large area in for example, generics, pharmaceuticals, where we are a global leader, and we can continue to build on that.
Right.
And there are other areas, special steels and other areas where we should also pull our weight. So I think there is no question in my mind that whether from a technological perspective, a demographic perspective, a geopolitical perspective, or even a global supply chain resilience perspective, India has to be an important part of the global economy into the future.
You mentioned our success in electronics. So talk to us specifically about mobile manufacturing success in India. So according to you, what has India done right exactly on the front of mobile manufacturing?
So there are many things that meant that smartphone manufacturing has taken off in India. One is obviously we have a large market, so that gives us an advantage. And of course, GST created a common market that made it further easier. So already there was some minimum cluster domestic market that you can leverage. Secondly, of course, more recently we have been encouraging using the PLI schemes, for example, to creating clustering here. And also improvements in infrastructure, whether the ports and airports, which are used for both bringing in inputs and flying out the output. Both of them have improved over time. So this is an area which we have obviously doing well in, but we can use the same experience to spread into other areas as well.
Okay, but you know, when you talk about manufacturing and especially electronics manufacturing, you can't have that conversation without really taking China into account. So finally, do you think we are now a little closer really to finding our competitive advantage over China in the mobile manufacturing space specifically?
No, I mean, there is no question that China is far ahead of us right now. But there are areas where we can compete, and we will put in our best effort to do so. Do remember that for the time being, China is both an important trading partner and a competitor. And there are areas where they will vacate, we can move into those areas, and there are areas where we can compete with them. I don't think we should simply assume that we cannot compete with China. There are areas where we can compete with China, and we should to try and do it. But at the same time, we should not wish China away. China is there, and it is a formidable economic player with whom we have no choice but to engage.
Okay, so since you specifically spoke about you know, China being an equal trade partner as well as a competitor, the finance minister yesterday also spoke, if I'm not mistaken, this was at the Peterson Institute of International Economics, and she cited that there's a fine balance between what we call Atmanirbhar, self-reliance, and price arbitrage. Now this, of course, with the focus on producing goods in India as a priority, but India being open to import as well, where we get better price economics. So which are these goods where importing is better than manufacturing for India?
So there are many areas where we will export, many areas we will import. It's difficult to give a sort of list, because this is not a static list, it keeps evolving. So I think first of all, you know, having a static view of the matter is in itself a wrong way of looking at it. There are many areas where the trade will be in the same area. We may be importing in the same sector, we may be importing some things and exporting some other parts. So
Yeah.
I think this is an evolving thing in which we need to have a dynamic system of being able to monitor it. Where, for example, we want to provide PLI schemes, we need to do that. Where tariffs need to be changed, or internal GST, or infrastructure needs to be built, it's something that needs to be dynamically judged. I think the whole idea of doing it in a static way in itself is wrong.
Right. Sanjeev Sanyal, thank you so much for joining us. I know you're on a schedule, so I'll not take any more of your time, but always a pleasure talking to you. And from there, let's move on to, of course, another big story that did the rounds today. Earnings season is on. The Nifty 50 has kicked in by announcing, by companies announcing their quarterly earnings. And of course, the first off the block was TCS. TCS announced its Q4 earnings earlier this evening. And I've got my colleague Soyash to help us understand those numbers. Soyash.
Thank you for having me, Kartik. So the IT bellwether did miss estimates on both profit and revenue front. TCS reported a 5% quarter-on-quarter jump in net profit at 11,392 crore rupees in Q4 compared to 10,846 crore in the previous quarter. The number was below street estimates, which had pegged net profit at about 11,562 crore for Q4. Now, revenue for the company surged about 1.6% over the previous quarter and came in at 59,162 crore rupees in Q4. Again, marginally below street expectations, which had pegged revenue at 59,300 to 59,500 crore rupees. EBIT, on the other hand, was up 1.4% to 14,488 crore, though it missed street estimates again by about 2%. The company's full year revenue rose 17.6% year on year to 2,25,458 crore. In constant currency terms, it was up 13.7%. Now, net profit for FY23 stood at 42,147 crore, up 10% over the year ago period. Now, despite the banking crisis, TCS's total contract value, or which the number of new deals, rose to about 10 billion in the March quarter on the back of highest number of large deals recorded in this quarter. Now, for the full year, the total contract value stood at about 34.1 billion. TCS has also announced a final dividend of rupees 24 per share.
Right, Suyash, interesting numbers coming in there. And of course, this is just the start of the earnings season. During the week and beyond, we will continue to track major numbers coming in, and Suyash, of course, is going to be with us. Now, TCS, incidentally, is, of course, the largest private sector employer in the country. And this, of course, on the back of 5 lakh employees that it has on its payroll. So important numbers there for the market, for the employees, and we'll continue to track the earnings season as it progresses. Suyash, thank you so much for joining us. And with that, let's move on. Of course, this is a sad development today, which pretty much marks the end of an eventful and enriching end to the life of one of the doyens of India Inc. Of course, we are talking about Mahindra and Mahindra chairman Keshub Mahindra. He left us for his heavenly abode this morning at the age of 99. The news of his death saw many corporate leaders acknowledge his contribution and enduring personality. Raymond Chairman Gautam Singhania, Puneet Goenka, CEO of Z Entertainment Enterprises, former CEO of Infosys, and Sanjay Kapoor, Chairman Sona Comstar, paid glowing tributes to him on Twitter. A well-known philanthropist, Keshub Mahindra joined Mahindra and Mahindra in 1947 and became chairman in 1963. A Wharton graduate, he was instrumental in transforming the company from the assembler of Willys Jeeps in India to a diversified conglomerate. He also served on many government panels like the Sachar Commission on Company Law and MRTP, and the Central Advisory Council of Industries. Now, after leading the Mahindra Group for 49 years, he retired in 2012. On that sad note, we'll of course wrap up this edition of Business Plus. For more news and updates, keep streaming Newsline Live.